Have you ever seen a company absolutely crush its earnings? I mean, put up numbers that seem almost impossible, and then the market just shrugs. It's a bit of a head-scratcher, isn't it? Today, we're taking a deep dive into just such a scenario. Broadcom's Q3 2025 earnings, they're, a powerhouse in the semiconductor world, and their recent report was, well, nothing short of extraordinary. Our mission today is to unpack these incredible results, particularly how deeply they're tied to the booming world of AI, and also to examine their surging profitability. But critically, we also need to understand why, despite what looks like overwhelmingly positive news, the market's initial reaction was described as muted. Okay, let's start digging in. Let's jump straight into those headline figures because they really do tell a compelling story. Broadcom, trading as AVGO, reported Q3 2025 revenue of $15.95 billion.
Right.
That actually sailed past forecasts by $130 million. But here's the kicker. This represents a robust 22% year-over-year revenue jump.
22% is substantial growth.
Exactly. And if you look at their diluted EPS, it hit $1.69, outpacing estimates by $0.03. Now get this. That's a stunning 309.9% surge in diluted EPS year over year.
Wow. Okay. Over 300%.
300%. With figures like that beating expectations on both the top and bottom lines, you typically expect fireworks, right? So what could possibly explain the market's rather subdued reaction?
That's the fascinating paradox right there, isn't it? Even with such impressive beats, the market often has expectations baked in, especially for companies, at the cutting edge of high growth sectors like AI. The bar is set incredibly high.
So they were already expecting amazing numbers.
Pretty much. A muted reaction despite stellar numbers implies that investors are already anticipating strong performance. In essence, while Broadcom executed exceptionally well, it largely aligned with, or maybe just slightly exceeded, an already aggressive set of forward-looking expectations that were likely already priced into the stock. It really speaks to the intense scrutiny and inherent optimism surrounding these AI leaders.
Right. It really makes you think about how quickly market sentiment can get ahead of even fantastic performance. So if the market's expecting perfection, what exactly is fueling these blockbuster numbers? I hear AI is a massive factor here. How much of Broadcom's success is truly tied to that AI boom?
Oh, it's absolutely central to their story. The numbers are incredibly telling. AI semiconductor revenue soared to an astonishing $5.2 billion in Q3.
$5.2 billion just from AI chips.
Just from AI chips. That crushed expectations and represents a massive 60% increase year over year.
60%.
And if you look specifically at their AI networking segment, that growth is even more explosive, up over 170% year over year.
Oh, okay, 170%.
Yeah, and this isn't just general demand either. It's driven by very specific, powerful products. We're talking about custom AI accelerators, which are, specialized chips designed for unique AI tasks.
Right, custom jog.
Their cutting-edge Tomahawk 6 switch. That's a powerful, high-speed networking component, absolutely essential for demanding AI data centers.
The Tomahawk 6, that sounds like it's built for serious data throughput, like moving mountains of data.
It really is.
And these custom AI accelerators you mentioned, they're essentially tailor-made chips for specific big clients.
Precisely. If we connect this to the bigger picture, these custom AI accelerators and specialized networking components are really Broadcom's moat. They're significant competitive advantage in the AI space.
For defense.
Exactly. By designing these bespoke chips, they embed themselves deeply into the infrastructure of their major clients, making it much harder for competitors to step in. The Tomahawk 6 switch, for example, it's not just about raw speed, it's critical infrastructure enabling the massive data flows that modern AI workloads absolutely require.
Got it.
However, this raises an important question. While AI is booming and clearly carrying the company, the source notes that non-AI chip revenue actually shrank 5%.
Oh, interesting. So a decline there.
A 5% decline. What does that tell us about Broadcom's strategic focus and perhaps, a broader industry shift?
So AI is clearly the engine, making up for maybe some softness in other areas. It sounds like a significant strategic pivot.
It certainly looks that way.
But it's not just about how much revenue they bring in, is it? It's about how much they actually keep. And on that front, Broadcom seems to be doing incredibly well with its margins. They're getting fatter, right?
You're absolutely right. The margin expansion is truly impressive and speaks volumes about their operational efficiency. It's quite something. Their EBITDA margin hit a robust 52% in Q3.
52%?
Yep, up significantly from 49.2% last year. And their net income margin, well, it exploded, reaching 26% from 11.4% last year.
Wow, more than doubled.
Exactly. This isn't just a slight improvement, it's a dramatic increase in profitability per dollar of revenue.
Okay.
Furthermore, their cash generation is equally strong. Cash from operations was $7.17 billion in Q3, with free cash flow of $7.02 billion.
Huge cash flow numbers.
Substantial figures that indicate a very healthy, cash-rich business. This operating leverage is clearly boosting shareholder value. You can see it in the return metrics, too. Their return on invested capital, or ROIC, reached 15.1%, up from 13.5% last year. And their return on equity, or ROE, as you noted, more than doubled to 27.1%.
A doubled ROE really jumps out at you. Could you quickly break down what ROIC and ROE signify for us, maybe in simple terms, and why that kind of jump in ROE is so important?
Certainly. So ROIC, return on invested capital, essentially measures how effectively a company is generating profits from all the capital it has invested, both debt and equity.
Okay, total capital efficiency.
Right. A higher ROIC means they're using their capital more efficiently to create value. ROE, return on equity, focuses specifically on the shareholders. It shows how much profit the company makes for every dollar shareholder equity.
Got it.
So when ROE more than doubles, as it has here, it indicates a significant increase in the profitability generated for its shareholders' investments. It's a strong signal of a very well-managed and financially robust business, effectively translating its revenue growth into impressive bottom-line returns.
So with this kind of financial muscle, this efficiency, what are they telling us about what's ahead? Does Broadcom expect this AI party to continue, or are they anticipating any shifts in the landscape?
Well, the guidance from Broadcom suggests the AI frenzy is far from over, very much continuing.
Okay.
They've actually raised their Q4 revenue guidance to $17.4 billion,
$17.4 billion.
which is well above street expectations. Even more specifically, their AI semiconductor segment alone is expected to deliver $6.2 billion in Q4. Again, significantly higher than what analysts were forecasting.
So the AI momentum is accelerating into Q4.
Seems like it, and their CEO, Hock Tan, has even doubled down on a 60% AI growth mantra for 2026.
60% growth for 2026 as well, that's bold.
It is, and this isn't just internal optimism either. External validation from Wolf Research confirms this momentum, specifically noting a new XPU customer that is set to drive material revenue in the second half of 2026.
A new XPU customer. That's a really interesting detail. What exactly does an XPU customer signify in this context of custom AI chips? Is it like a whole new kind of client or just an expansion?
Yeah, that's a good question. An XPU customer typically refers to a client that is developing or utilizing highly specialized processing units, so going beyond just traditional CPUs or GPUs for unique AI or high-performance computing workloads.
Okay, very cutting-edge stuff.
Exactly. In Broadcom's case, with their expertise in custom AI accelerators, it strongly suggests another major player is partnering with them for bespoke chip designs. This indicates not only a continuation of demand for their custom solutions, but also, potentially, a diversification of their client base or expansion into new, very advanced AI applications. It really reinforces their position as a critical infrastructure provider for the cutting edge of AI development.
That sounds like fantastic news for their future prospects, kind of cementing their position in this whole AI race. But this brings us full circle back to our initial question about that muted market reaction. Despite all this fantastic news, the stellar results, the strong guidance, the market seemed to say, yeah, we expected it. This really leads us directly to the valuation question. Was Broadcom stock already priced for perfection?
This is truly the crux of the matter. It really is. While the stock did soar after hours, reaching $350.74 and surpassing its previous all-time high of $317.35.
Right, it did pop eventually.
It did. But the valuation metrics are where the market's extremely high expectations become clear. Broadcom is currently trading at a rich 34 times fiscal year 2026 earnings.
34 times, 2 years out.
34 times FY26 earnings. To put that into perspective, that's about a 7-turn premium to NVIDIA.
Wow, a premium to NVIDIA.
A significant premium, yeah. And NVIDIA is itself considered a valuation leader in the AI space. So this raises an important question. When a stock trades at such a premium, especially compared to an industry giant, it means the market has incredibly high expectations for future growth and, crucially, for flawless execution.
Flawless execution. That's a high bar. And when expectations are that high, even a slight stumble could have significant repercussions. That sounds like a tightrope walk.
Exactly, that's precisely the term. This is why analysts are issuing warnings. They point to the lumpy nature of custom AI revenue. Unlike standard mass-produced chips, these custom orders can be irregular in their timing and scale.
So not a smooth, predictable curve.
Potentially not. It could introduce volatility into their revenue streams. There's a clear high valuation risk. The market expects perfection, and while Broadcom's execution so far has been remarkably strong, that lumpy nature of custom orders can indeed introduce a level of unpredictability. It's a classic high-reward, potentially high-risk scenario for investors, demanding continuous, flawless execution to justify that premium.
Okay, so high growth, high expectations, high risk potentially. But amidst all this talk of soaring AI growth and these tricky valuations, it's worth noting another facet of Broadcom that speaks to consistency and stability, perhaps a counterpoint to that high-flying AI narrative.
That's an excellent point to bring up. While the focus is heavily on the AI-driven growth and the associated valuation, Broadcom also offers a layer of financial consistency that, often goes unnoticed in such a dynamic environment.
What's that?
Their dividend. They maintain a steady dividend of $1.59 per share quarterly, yielding around 0.8%.
Okay, 0.8% yield. Not huge, but it's there.
It's not huge, no. But what's truly significant about this isn't just the yield itself, but their long track record. They've had 16 consecutive years of dividend increases and counting.
16 years of increases, even with all the tech cycles and market shifts over that time. That's genuinely impressive for a tech company, especially in semiconductors.
Indeed, it really is. While the dividend yield itself might seem modest compared to the stock's growth potential, those consistent increases over 16 years. Especially for a company in such a high-growth, high-volatility sector like semiconductors and AI speak volumes. It says a lot about their underlying financial health and management's confidence.
Confidence in the long term.
Exactly. It signals their belief in sustained profitability and strong cash flow generation, even when parts of their business might feel lumpy or market sentiment fluctuates. It provides a measure of stability in an otherwise rapidly evolving landscape.
So as we wrap up our deep dive today, Broadcom's Q3 was truly a masterclass, wasn't it? Leveraging the AI boom for both growth and profitability. They're effectively turning custom AI accelerators and high-speed networking components into a robust moat, a deep competitive advantage in this rapidly expanding field.
A strong position.
And they're becoming significantly more efficient and cash-rich, which is fantastic for the business itself. But, as we heard, the caveat is clear. That high valuation means the market demands flawless execution, leaving very, very little room for error.
That's the takeaway on the risk side, absolutely.
Broadcom's story really makes you wonder. In a market so captivated by the promise of AI, can any company truly sustain perfection in the eyes of investors? Or is a premium valuation always a tightrope walk between incredible potential and the constant threat of unmet expectations? What do you think is the bigger story here, the undeniable AI boom transforming industries, or the ever-present shadow of market expectations and the definition of perfection it casts on these leading companies? Something to think about. We encourage you to keep exploring, keep questioning, and keep diving deep with us.